Friends, buckle up because things just got real in the auto world. And by real, I mean expensive and confusing. As of today, April 9th, 2025, Canada slapped a hefty 25% tariff on US-made vehicles. This move is a direct response to the US doing the same thing to Canadian cars earlier. It's like a playground fight, but with billions of dollars and international trade agreements at stake. This "you started it" tariff war has investors sweating bullets. They're worried about what it means for the already complex North American auto industry. See, car manufacturing is like a delicate ecosystem. Parts cross borders more often than a flock of geese on a mission. This tariff thing throws a wrench into the whole operation. Companies are left scrambling to adjust supply chains and figure out how to swallow these extra costs. And nobody, least of all investors, likes uncertainty. The big question now is, how long will this tit-for-tat tariff battle last? Will it escalate further? And what will be the ultimate cost to consumers and the economies of both countries? Stay tuned, folks. This story is far from over. Unsurprisingly, the news of these automotive tariffs has sent shockwaves through the financial markets. It's like someone just spiked the punch bowl at a Wall Street party. Investors, who are generally a skittish bunch, are now running for the exits. The S&P 500, a key indicator of the US stock market's health, took a nosedive. It plunged nearly 5% into bear market territory, a term that's scarier than it sounds, unless you're a bear, in which case, congrats. This market volatility reflects the deep uncertainty surrounding the trade dispute. Investors hate uncertainty more than they hate boring PowerPoint presentations. And right now, there's enough uncertainty to make a fortune teller nervous. The big fear is that these tariffs are just the tip of the iceberg. What if this trade spat escalates into a full-blown trade war? We're talking higher prices for consumers, job losses, and slower economic growth. And nobody wants to be holding the bag when that music stops. Remember that new car smell? The one that usually comes with a whiff of debt and regret? Well, get ready to experience it with an extra dose of ouch. Thanks to these tariffs, new cars are about to get a whole lot more expensive. Analysts at J.P. Morgan, those financial wizards who wear suits even on weekends, predict that new car prices could jump by a whopping $4,000 to $5,300. That's enough to buy a used car, or a small island, or, a year's worth of groceries. This price hike is likely to put a damper on car sales. People who were on the fence about buying a new car might just decide to stick with their old clunkers a little longer. And who can blame them? So, if you're in the market for a new set of wheels, you might want to act fast before prices go through the roof. Or, just invest in a really good pair of walking shoes. The Canadian dollar, also known as the loonie because it has a picture of a bird on it, go figure, is having a bit of a moment. In the wake of the tariff announcement, the loonie actually strengthened against the US dollar. It's like finding out your awkward introverted cousin suddenly became the life of the party. You're happy for them but also a bit confused. This unexpected currency fluctuation is likely due to a phenomenon known as repatriation. Basically, it means that Canadian investors spooked by the trade tensions are bringing their money back home. They're like, things are getting weird down south. Let's move our money to a place where people say "ay" and apologize excessively. This influx of funds into Canada is boosting the loonie's value, but how long this trend will last is anyone's guess. Remember all those Canadian investors who were snapping up US real estate like it was going out of style? Well, they're not feeling so bullish anymore. The trade war has thrown a wrench into their plans, and now they're starting to rethink their investments. Since 2015, Canadians have poured an estimated $184 billion into US real estate. That's enough to buy every single avocado toast in California. But with the trade war looming large, some investors are getting cold feet. They're worried about the impact of tariffs on the US economy, and they're not thrilled about the prospect of holding assets in a country that seems determined to engage in a trade war with their homeland. So, what are these investors doing? Some are reducing their exposure to the US market, others are looking for opportunities elsewhere, like Europe, where the croissants are buttery and the trade wars less frequent. The Canadian government, faced with a potential economic crisis, is scrambling to come up with a plan. It's like watching a group of dads try to assemble a swing set on Christmas Eve. There's a lot of head-scratching, some mild swearing, and a distinct possibility that things won't go according to plan. Prime Minister Mark Carney, never one to mince words, called the US tariffs unjustified. He promised carefully calibrated countermeasures to protect the Canadian economy. What does that mean exactly? Your guess is as good as mine. The government is considering a range of options, from reinvesting tariff revenue into relief programs to providing financial assistance to affected businesses. They're also looking at ways to diversify Canada's trade partners and reduce its reliance on the U.S. market. Will it be enough to avert a full-blown economic crisis? Only time will tell. The trade war between the U.S. and Canada is still in its early stages, but the potential long-term economic implications are significant. It's like that moment in a horror movie when the characters hear a strange noise in the basement, but they decide to investigate anyway. Spoiler alert, it doesn't end well. The tariffs are expected to drive up prices for consumers, reduce demand for goods and services, and slow economic growth in both countries. The auto industry, which is heavily integrated across the US-Canada border, is likely to be hit particularly hard. The trade war could also lead to job losses, business closures, and reduced investment. In the long run, it could undermine the competitiveness of both the US and Canadian economies, so, yeah, not great.